Hello, Warriors. Let's have a great week. How are you, Alexander? Jamie? Bran? Celestial Events. Hi, Richard. Kman. How are you, Ryan? AJ? All you guys, how you doing?
Morning, mate.
So is the euro going to come out of here today? Pound and euro? If they can't break it, is it heading higher?
Hope so.
Okay. All right. So what levels should we be paying attention to in euro?
We've got this short-term level up around sort of 106.10. Then we've got another one, 106.35, just around 35.40, that prior high. You've shown a bit of traffic there around 45.50 as well. Yeah. But the big level's still 107. That's really the first big step it needs to take.
Okay, and underneath it, what it needs to hold, are we back to that 530, or should we tuck it up a little bit?
Yeah, it depends. Yeah, if you want to scalp it, you're going to be looking around that 70 area. Have another little go if it's down at 30s. 105 is the big number. So there's a couple of levels there if you want to mess around in the short term.
What would make you constructive the dollar maybe for one more run? Anything? That, would it have to be some kind of fundamental shift or a move in yields?
Probably it would need a fundamental shift. Not necessarily from the US side, but if everyone else does worse, you're going to get extra flows into the dollar. But the problem is how long does it all last now? I mean, if the Fed hike again, perhaps it's one more. That's not going to get dollar bulls all excited and sending the euro down to 103 or anything like that. So it's really got to be weakness elsewhere twinned with the US remaining to do okay. That'll keep the dollar well bid and maybe start to grind something like the euro dollar lower. But at the moment, the market's happy with what it's pricing really, which is why it's stopped going down.
Okay. I can't remember a time where the yen has been shown less range and volatility in a long time. Is there a message in that? Don't trade it.
Maybe. Well, you're not going to buy it at 149.90, are you? And you can't sell it for too long at 149.99. So unless you're scalping in and out for 5-10 pips, 50 times a day, you can't sit on it and wait for it.
Where's the next big move coming?
Ooh, I think it's going to bust up. I think it's going to bust up.
Okay, 52-ish.
That's possible. Yeah, up towards those prior highs that we got last year. Yeah, it's possible if this 150 goes, but you never know with this thing. You look at that price action there. It was a strong run up to 150. Late September into October, and that's why we got a big reaction down. This one has been more grindy. It's the dips are really shallow. So price action would usually in this situation mean that if we do break, it's going to break possibly quite violently. But as I say, with this pair, it could just grind up. Tomorrow we're trading 150.15 for 5 hours, and then through the week we get to 150.50. You just never know with this one.
Just something I noticed a while ago is that on the weekly, we haven't taken out the high yet, but if we took out 52, the momentum would be much lower than it was going into it last year. So that's something that I've been noticing.
Good spot. Different conditions.
How about China, besides sending destroyers into the Mediterranean to keep our aircraft carriers company?
Oh, they got destroyers, have they? I thought they'd be too busy hassling Filipino fishing boats or something like that. That's a usual ploy.
No, they were. It's a world. The world is focused on it, and they want to be part of it. And also, Iran's their client state. So they're there.
It's a big jamboree, isn't it, in the Med?
Yeah, I don't think it's a party.
No,
so
but this is why the wider geopolitical implications need to be kept an eye on. This isn't just Israel and Hamas. The others are all putting their stamps on it, aren't they?
Yeah. And it seems like the market gets relief, is able to maintain relief because there wasn't an invasion. I guess we may as well talk about this. So they took out the lows, right? We took out 42, and is it going to be a major breakdown, or was it a stop hunt and they end up trying to hold it? I was reading a lot of people looking for a crash, a lot of people looking for, showing the analogs with 87, and I think it'd be pretty classic. I'm not saying this is the low, but that the market holds and the bears get laughed at one more time, and then we just get a little feeble rally and then break. But I don't know if it's happening here today or not. It seems like there's a little buying coming in. So I think that's going to be, we'll see if 4,200 means as much here as it meant on the upside, because it was significant on the upside.
Mm-hmm.
That's a test that held, right? Testing the breakout. And now we'll see what it means for, possible decline or not.
Yeah,
Probably
I
be a
think
head
we saw the stocks go. They went down to 41.90, and then it's typical price action. Trigger underneath, and then we bounce. But unless we get back above sort of 42, 14, 15, it's in doubt.
Because this held pretty much the 50-week moving average here.
Yeah,
that's exactly what it held. Then if it gets through there, you would think it would go for the 200 week, which is a number a lot of people have, including me, 39.5 or so. Gold, silver, to try and sell it off, but keeps holding. Gold a little bit better looking formation than silver. You were long gold. You still long gold?
No, I was short gold. I tried it against that 1986 for a quick grab. Got a 7 ticks out of it, and then gave it back on the stop. So another one. You got to be nimble. You can't short it for too long, because the price action just tells you, it'll hit a level for 5 minutes, dip, and then it'll go right through it.
Yeah, platinum isn't confirming this move. Maybe it will now. Kman, you around today?
I am extremely around. Hi, Dale.
All right. Good morning. How are you?
Yeah, very good. Thank you.
What's going on with the loonie here? Is it a sale? Is it a sale against this high? What do you think?
That's the question, because we are hanging above that resistance box that we had between 136.5 and 137 for a long time.
Yeah.
For as long as you don't go back below there. Below, I think there could be an acceleration. But we also have Bank of Canada this week, and there have been a bit contradictory data out of late. As Ryan already pointed out several times, McLem was quite hawkish until then. Those numbers we had last week, which were weaker than what they would have expected and us would expect. So I don't know if I want to counter trade this right here and now. I'd rather see it back below 136.5 before starting to hit some buttons.
Okay. All right, so that's kind
for
of
the rest,
picture.
We're in ranges in the majors because the interest rate differentials, despite those US yields ramping higher, the differentials are not moving much. If you look at the euro, sterling, for instance, and even the Aussie and things, the differentials themselves are not moving that much. The other yields are going in tandem with the US yields, which I think, and you were asking about the next move in dollar. I think it may spark the next move in equity markets. If really all those yields continue to go higher and push higher into year end, then I don't think the equity markets will hold. And I was a bit surprised actually, because on Friday this S&P move, I thought a lot had to do with the OPEX.
Yeah.
But then we opened this morning, and yet there was another leg lower. Yeah.
Yeah. I last night I think they were up 13, 14 when I looked at them. So it must have happened in Asia or Europe when they took it down.
Yeah, it happened early in the European time.
Okay. Those stop hunters, probably some guys from the UK.
Yeah,
know a few,
probably. Can't trust those guys.
pushing it. So okay, all right. So yields,
As I was saying, I mean, there's a bit of tech around this 5% in the US, 5% in the US 10s, and we are less and less inverted as well. That's going to be an interesting watch. If ever we can completely uninvert on the 2s and 10s, there may be another leg in the dollar, then I reckon. But the long end is still very, very strong. The 30-year at 550, 515. That's some move. Yeah, those yields.
Yeah, TLT's priced a full point lower. That should be a new low for the move. That's a 20-year proxy.
Yeah.
But one thing though I want to point out, compared to all the way down, there are some momentum divergences beginning to build here and here, right? See, I mean, this is the first non-confirmation pretty much all the way up. So it's the first time. So could be important.
Was it similar as the one you had earlier in October there? Well, is it like kind of similar? No, not really. Well, from the 4th until, just there, was it kind of similar there? Would you say looking similar?
No, because this I think was the same high, wasn't a higher high. So I mean, but it diverged. Let's see, maybe by a pip, it was a higher, 488.70. Yeah, by 0.003, it made a new high. Yeah,
but then we did have the
nice correction,
nearly 30 bps setback, right? So that was pretty decent move.
Yeah,
I think this week, I'm not sure that PMIs will change a lot to the interest rate picture, but we may have different drivers than the dollar, right? We have the ECB, we have the Bank of Canada.
Wow.
Well, I mean, imagine ECB starts to talk about QT accelerated, then we could have another push higher in the yield sphere. By the way, this 5% on the 10s, if that breaks, I don't see anything before the highs, just before the GFC, 530. And those, as I already said last week, those 25-30 BPs could cause quite a bit of pain if we get to see them.
Here we are. So you have to go back to your monthly.
Yeah,
to see it.
Exactly.
Okay.
Hey, good morning, team.
Hey,
good morning. Kman, you were just talking about the ECB and QT. What do you think they're going to do with the PEP program?
Well, that's the thing. I wasn't expecting anything before December, but now there's starting to be a few voices here and there. We heard from, of course, they are the most hawkish guys or girls in the ECB governing council, but they talk about it, and if they don't have to change the yields, but if you start to increase QT, that is something that will zoom in the background and keep the yield supported and tighten financial conditions quite a bit, with yields already pushing at the highs. So I think that could be the kicker for the ECB meeting, because I don't think they will change the interest rates, but that could be the kicker on Thursday.
And if you look across, the euro pairs, this is where, you got Ryan's already been sniffing out, euro strength as it is, being on the long side of the euro this last week. By the way, that's awesome, Ryan. Great job, because the euro's just been, steady climbing into that 106 level. But you see the euro crosses are all starting to look pretty perky, and that's pretty normal in a risk off type of environment. You see the euro crosses tend to outperform. You got the euro sterling that looks good. You got the euro Aussie that looks like it could really rip higher. Same with the euro Kiwi. Obviously the euro Swiss is going to be a different story with the Swiss franc, but euro Mex looks good. Euro Canadian. I mean, the euro looks poised if they really start fiddling with the PEP programs.
I exactly spoke about that end of last week and this morning on the Flow Show. This is now third or fourth consecutive European morning where the euro crosses are bid very big, and I mean it's also provoked by the differentials. Well, when the US yields go up, the European yields seem to really follow in lockstep.
Dale, do you want me to grab the chart? Sorry, Kman.
But the euro, but the euro crosses are really strong. So Ryan, you were talking a little bit about the euro as well. Do you have any thoughts on what Kman's saying?
Yeah, no, it's exactly what we discussed on the Flow Show. And I think the other thing I forgot to mention that's been picked up as well, aside from QT, is the deposit stuff that they've got over there. There's still a lot of money being parked up at the ECB, and they've got all this tiering or whatever. So they might, remove rates from that or cut rates on how much people are getting parking at the ECB to get that money flowing again. So there's a lot of intricacies for the ECB Thursday. Probably for now we can forget the rate trade. They're on pause. Inflation's going the right way. They're going to stay on pause. That shouldn't change. So it's going to be about what they tinker with underneath everything else.
Sure. All right. Dale, let me ask you really quick, since obviously you're really focused on equities. How do you feel about this 4,200 level? I mean, it's obviously very critical here.
Yeah. I kind of think that it won't collapse from here. Then so they could feel some relief and ridicule the bears. But then have a little bit of a pop back to 4,300 or so, and then go, because everyone was over the weekend a lot of talk about Black Monday. So unless Israel invades during the market session today, I think that's what's going to be bearish. Is the market seems to have relief that President Biden is asking Israel to hold off to try and get more hostages out there. I think the market will get nervous on the beginning of the ground offensive in Gaza.
Now, let's not forget that this is a busy earnings week. Today is not so crazy. Yeah, we got Microsoft tomorrow, right? Yeah. So you got Mr. Softy tomorrow. You got Google tomorrow. You got Visa, which is going to kind of give us the kind of gauge of where the consumer's at from a credit point of view. You got Meta on Wednesday. You got IBM on Wednesday, Boeing. You got some big names that are reporting this week. Anything that's on your radar in particular, Dale?
It's I don't really play the earnings game. I may hold positions into them, but I have no idea. We'll see if that could be the excuse for the market not to break hard from here. I think the market's going to break hard. I'm still looking for minimum 39.60. I'm just not sure that the taking out of the stops was not a stop hunt yet. Okay, so that's I'm short. If it goes, great. If it holds and we get a little bit of a rip and everyone's saying see bears, 4,200 didn't mean anything, then I'm a seller to add on. Okay. What are you doing? Right. What are you looking to do in the S&Ps here?
I don't know. I mean, it's as you can see on my chart, it is a very, very tricky area. It's hard to sell into this level. I think we are still headline dependent, and things, even though we're getting the aid into Gaza, it's and it's still a very, very intense situation over there. So I'm still playing it as risk off. It's hard to just press the button and start shorting risk at these levels. But I think it's really,
So you would sell a rally on good earnings?
I would definitely sell a rally. I'm in sell rally modes. I just don't know if I'd be a buyer here. That's the tricky part.
I wouldn't be.
What's that?
I wouldn't be a buyer.
No, I mean, give me some good reasons to be buying right now. I mean, other than, every commentator on CNBC says we're oversold, but are we? They said we were oversold last week, and here we are, several percent lower. And you might look here and say, well, this is maybe divergent, but who says this is going to be divergent? I mean, we could sell off and trade down to 40, we could trade down to 40, 50 here. And this RSI could actually pierce into finally oversold situations. And that's going to be a confirmed low. So I'm not willing technically to stand in front of this market right now. It just doesn't make any sense to me.
Yeah. I think Nvidia sealed the deal last week.
Yeah. Well,
for the beginning of a pretty good bear market going into at least year end.
Yeah. Well, okay. So we got, let's central banks. We got the Bank of Canada this week. I know Ryan came in. You talked a little bit about this. We're up against very, very critical resistance. What's the chances of us breaking above 138 this week in the dollar CAD? What do you think, Ryan?
Yeah, of course it's possible. I think it's going to be what the BOC do is the possibility if the dollars remain strong. The BOC, says, okay, we talked about getting a bit hawkish, but we're not really. We're going to stay on pause and rates are going to stick around. Then maybe we get a push up there, but it's going to need both the dollar and CAD weakness to do that, I feel. And that might be a bit difficult depending on what oil's doing and risk is doing.
What do you think, Kman? You have any views here with the Bank of Canada? I know you were talking about it just a little bit earlier, but do you think we're going to break out this week?
Wow, that is one very good question. Well, they have the power to do so. If McClellan turns around and says like, oh, perhaps I was too hawkish, then you're going to see a big leg lower in the Canadian dollar, I reckon. And but for the time being, it's more pushed by crosses than really the dollar in my as the price action shows. But for as long as this block, that I was saying like 136.40, 137, 136.5, 137, call it, for as long as that holds, there is a good chance that we are going to at least have a visit of the level up there.
Yeah, and I was just glancing at it. This is the 50 DMA. You can see it right here. So see how the moving averages to me are not super important. They're trend, indicators for me. But every once in a while you find an asset that's like it shows you it's respecting, like in this case, the 50 DMA pretty good. So I would look at this chart and basically say, while we're above the 50 DMA, I don't think there's any reason to be on the short side, and that's, you can see how it's kind of just squeezing up into, key resistance here. But we'd have to get below the 50 DMA for me to be convinced for technically at all that we should be selling dollars and buying Canadian dollars at this point. Mm-hmm. But what's really interesting, and one of the things that's kept it capped, so to speak, is the strength we've seen in crude oil. Obviously, we've got crude that's trading well above 85 and closer to 90, and that's keeping a lid on the dollar CAD. But
yeah, and also
I tell you, it's this one's wound up and ready to go for me. Hey,
also
go ahead.
Blake, I think there's the proximity of the US with the US dollar being doing pretty well. That's kept the Canadian dollar from falling out of bed perhaps until now. But then if you look at stuff like the Norwegian kroner, for instance, that has not benefited more than 2 sessions from higher oil. Look at where we are. This is the Norwegian kroner is extremely weak.
It is. It really is. I mean, this channel, you just can't really ignore it. And I know a lot of people look at Norway and go, man, you know, it should be bought here. But we have to also realize it's not too far from its all-time lows here. I mean, that's how scary Norway looks. So,
and that is important because Norwegian kroner should have been indeed much stronger.
Oh yeah, and I agree. And I look at this and go, when this happened, and Stelios isn't here right now, but we talked a lot about it during, you know, the COVID lockdowns. I looked at that and I said, man, that looks like a generational low to me. Like, you know, like Norway shouldn't trade below there, but here we are, you know, not too far away from it. It's pretty wild. So look, a couple other things really quick before we wrap things up. Let's talk about the elephant in the room, guys. We've got the 10-year, you know, at the 5% level once again. Here we are trading at the 161% extension, and I want to show you real quick, just for those of you that aren't looking, you know, on a monthly basis. This is a monthly chart. Let me move this drawing. Damn, let me get rid of this drawing thing. You guys can't see it, but I can. We're at the 161% extension on the monthly candles, but also you can go into the daily and realize it. Well, this is a 4-hour, but you guys get what I'm saying on over the course of the last 12 months. We're also at 161% extension. Couple golden fibs just trading right up against here. You know, this Dale, as you can see, clearly divergent relative strength. But here we are at 5%. What do you think, Ryan? Do you think we continue to press higher here in yields? I mean, data's good.
That way. Yeah, it's looking that way at the moment, isn't it? There's no reason for them to drop back significantly, is there? So, yeah, you have to say that it favours yields going higher, but whether it's a blow up or just a grind up is another question.
Yeah, I mean, they just, I mean, it is. I don't know if I'd want to stand in the way. I'm trying to, from a currency point of view. I had an alarm for myself personally set from weeks ago when we reached 5% on the 10-year to sell some dollar yen, and I sold some. And I'm literally down 3 pips right now on a trade that I took last week, sitting in a dollar yen short, and I'm not comfortable with it because obviously yields are so strong up here. But it does look like it's going to break out. Kman, what do you think? Do you think yields should break here?
I'm a bit in Ryan's camp. I fail to see, unless an economic setback in growth data, I fail to see what's really going to put them lower, those yields right now. So yeah, I think it can go on to this 530 zone. That's my view. Now there's something interesting going on, because I just saw Fed guy, Joseph Wang, posting something saying that the Treasury may start to issue more bills instead of longer term notes. So I don't know. Do they find things have gone far enough? That's a possibility as well. But yeah, in the meantime, I don't see what's going to put yields much lower now, unless we saw a real economic slowdown.
Yeah, and speaking of this week and economic data, we have some pretty key important data coming out later on this week. We have GDP data. We also have PCE. So Ryan, Kman, Dale, what data is on your radar this week that we should be watching, aside from the ECB and the Bank of Canada this week? Any US data that's really got your attention? Like for me, I know GDP is tends to be backward looking, but this is advanced GDP numbers that we're going to be looking at. We also have durable goods orders on the same day on Thursday. We got unemployment claims. Anything that's got your attention this week, Ryan? What do you think?
Yeah, I think that GDP is going to be fairly important. It's expected to quite hot, 4.2% is expected to come.
Yeah.
So that's going to be a bit tasty. Gives us a bit of variation risk, if you like, between if it's a big miss or a big beat. But yeah, then obviously Bank of Canada, ECB, and housing data. So there's plenty to tickle our fancy this week.
All right, Kman, any data that you're going to be watching specifically this week?
Yeah, I mean, for me, the two highlights are going to be the, well, three if you take the Bank of Canada, of course, but ECB. I'm going to be very curious what they do, and then yeah, the US GDP. There's going to be the market is going to take a point of measure from that. Yeah, those are the two highlights for me.
All right. Well, hey, I know, Dale, you got your guest here, and Kman, Ryan, thank you guys for keeping everybody up to speed, especially during the European hours during the Flow Show. If you guys don't know to listen to those guys on the Flow Show, make sure you do. They are broadcasting while I'm fast asleep, and I know Dale is as well. So have a great interview. What's that?
I still am.
It's Monday.
It's a hologram. It's a hologram you're seeing there.
All right, Dale. Have a great interview with Mr. Elliott. Ryan, Kman, have a great one. I'll see you guys tomorrow on the F.A.C.E show once again. And take care.
Thank you, team. Good, nice job, guys. We had a lot to say about not much happening in the FX arena. I tell you what, here's a man that's going to clear some things up for me and for everyone watching. Bob Elliott, how are you?
Good. How are you doing?
Good. Great to have you back, Bob. And since we last talked, one statement you said to me, I think it was our first interview, which was well over a year ago now, right? I asked you, I said, is this a bear market? And you said, no, this is not a bear market. You haven't seen a bear market yet. So are we getting closer to an inflection point where maybe we'll get some earnings misses this week with some of these big companies, where rates after a year have started to take impact on companies to where we might be close to seeing what you classify as a bear market?
Yeah, I mean, I think the main dynamic, you got to think about the ordering of how this works and how a cycle like this works, which is, when we talked a year ago, we hadn't experienced the dynamics that were necessary to get us to recession. It's why a year ago I said there was unlikely to be an immediate recession. And that ordering is, first the yields have to rise. Well, now we've got that basically.
So the steepening of the curve from
we have the steepening of the curve. Okay. We have the uninversion. Then asset prices have to fall. Well, we've gotten a little bit of weakness in stocks, but we really actually haven't gotten that much weakness. If anything, actually, stocks are more expensive today than they were when they peaked. Now, hold on. How can that be? How can the price be lower and the value and the asset be more expensive? It's very simple, which is bonds, which are which discount the future cash flow and discount the future earnings for stocks, have fallen a lot more than stocks have. And so as a result, the valuation on stocks is actually higher today than it was back, 3 or 4 months ago when stocks peaked. And so we're just starting that cycle, and we start to see days, we haven't seen that many days where really bonds outperform stocks. That's when you really know you've turned in this cycle, when bonds start to outperform stocks. Right now, we've basically been chopping sideways in that for
which is an improvement because we were continuing to go down, and the market seems to have somewhat of a bid coming in near these levels because momentum is not confirming the new lows in, say, TLT.
Yeah, and, well, I mean, obviously you guys look at it from a technical perspective, which is a totally different perspective than how I do it. But when I look at sort of from a more fundamental perspective, just trying to add up the buyers and sellers, like the thing that I think people often forget about bond sell-offs, because we haven't had that many in our recent memory, is that they're self-correcting, because what happens is the yields move higher, which then brings in the yield sensitive buyers, particularly tactically hedge funds and more structurally households. And that help, and then on top of it, the higher yields slow the economy, which means that there's less borrowing, which means that there's lower bond yields as a function of that. And so I think we're sort of in that zone where the self-correcting nature in the bond market is such that we're starting to get that sort of that ceiling in yields. Like you kind of feel it. You probably see this in the technical. It kind of feels like we keep sort of bumping and then coming back and bumping and coming back. And I think that's just that, in many ways it's a reflection of those sort of fundamental flows dynamics that I'm describing.
You're not a technician, but you're a tape reader.
That's right. That's right.
All right. So that's how you feel that kind of action and interprets. There was an announcement that they're going to go to more T-bills, shorter term paper in the next funding package, I believe, over the long end. That going to have any impact on the yield steepening?
Well, I think in a lot of ways that is the sort of thing that takes the risk, the tail risk out of the market. Like we've had basically just pretty much the most extreme amount of change in duration supply, from essentially no duration supply to meaningful duration supply here in the fourth quarter. And so my guess is that the Treasury doesn't like what they're seeing, and my guess is that they're going to try and fiddle with the mix a little bit, on top of the fact that the actual deficits on a forward-looking basis are still going to be elevated, but going to be less high because you're starting to get repayments from California and stuff like that. There are a couple of one-off things that created a particularly extreme deficit from sort of March to September, which is unlikely to occur over the course of the next 6 months. Still big deficits for this point of the cycle, but not nearly as extreme as we saw earlier this year.
Okay, so we have a geo situation that we have to keep at least one eye on, and I went to your stream, Bob, and you actually try to explain to people what it's like to have a war economy and what it means for markets. Can you share that with our viewers today?
Yeah, I mean, I think none of us basically have any idea what it's like to live through a major global conflict, right? I mean, we haven't seen if anything, actually, I showed some charts on there, which I thought were interesting. I hadn't seen before I started looking into it, which is that like global conflict is at like orders of magnitude lower than the sort of norms of the last 600 years. And so, that's basically how our careers and frankly, my whole life has been in that sort of state. And the issue with conflicts is that basically, if you just think about it from a fundamentals perspective, what you're doing is you're digging stuff out of the ground and you're creating production and then destroying it, right? That's the basic thing. And then you're financing it with large deficits, usually through yield suppression, in order to keep the financing costs down. And you put that all together, and what does that mean? That means it's a bad, inflation is elevated. Even though growth is elevated, inflation is elevated. It's both of those things are bad for bonds on a real basis. Typically bad for stocks because the economic rents basically go to the government rather than to the producer of the products for a variety of reasons that are probably intuitive.
The war machine,
the war machine, right? It's just that's the way it works. We socialize the productive capacity in one form or another. And then the other elements are, commodities do very well because you're digging them out of the ground and destroying it. And gold does well in that environment as well, because it's essentially the only money that's not being debased by governments in order to pursue the war effort. And so you put that combination together, that's essentially the best portfolio is gold and commodities. And then you think about how people are basically positioned strategically, which is bonds and stocks, and they're basically totally underweight.
Wrong side of the fence.
Right, totally underweight rising conflict.
Yeah, and I know that you're a believer in gold as part of the mix of a portfolio. So, I mean, I know you're a gold watcher. Was that one of the most dramatic rallies you've seen in gold in a long time? What did it do? Put $150 on?
Well, I think the thing that's really interesting, so gold, you got to think about, it's basically two things. It's a geopolitical hedge, which we all sort of know, but it's also non-yield bearing money. And so when you think about gold, in general, actually, you want to think about it relative to bonds, because, bonds pay a yield and gold doesn't pay a yield. And so even when I trade it or think about it, I'm trading a diff position rather than an outright position. I think the thing that's pretty amazing is how well gold has done relative to bonds. Which in the last few weeks, I mean, actually over the last 3 years, it's done fantastically well relative to bonds. But even in the last few weeks, I think that speaks to the bid it's getting from the geopolitical tensions. And like, these are the sorts of things, like, you know, gold has high convexity to these sorts of events. And so it's why in a portfolio, you actually don't need that much gold to protect yourself, but it doesn't take a lot of incremental buying to start to create meaningfully sized price action in gold. And so I think that's kind of what we're seeing is like, you know, in the grand scheme, the situation in Israel is terrible, and you know is contributing to increasing global tensions in the grand scheme of, you know, global conflicts. It is not, certainly not yet, nearly as substantial as those previous global conflicts, but we're still getting a significant bid in gold because it has that convexity. So I think that's what you have to, that's why gold is a great asset to hold as a small position in a diversified portfolio.
Okay, so why don't we talk a little bit about Japan? It seems like you have been stating the case that with what's going on, little inflation would be an improvement for Japan, right?
Yeah, I mean,
go ahead.
I mean, my career has I learned that basically Japan is in depression, and that's just the way it goes, and you know, deflationary depression. And I somewhat joked on Twitter last week that Japan may be like the best managed economy in the developed world, right? You know, for the first time in decades. And the reason why that is look, Japan needs a little bit of inflation. It's getting a little bit of inflation. We're not seeing most of that inflation is actually driven by the supply side and, you know, import inflation, which
they import everything.
They import a lot of stuff. You're seeing a modest uptick in wage inflation, but not a big deal. And their response is to do not much in response to that. You know, they're raising the cap a little bit, but like, you know, Japan is experiencing pretty good growth, you know, moderately positive inflation under the current monetary policy circumstances, and that all aligns. Like that's reasonable. They're basically handling things reasonably. They don't have that many excesses in the grand scheme of things, and so at least when I look at Japan, I don't see a lot of urgency to do anything different because they're doing a pretty good job the way things are right now.
So everyone waiting for them to make shifts from yield curve control, they're going to be waiting for a while.
Yeah, I think that's just like, why do they need to shift from yield curve control? Like what is the actual compelling case? Like, they don't have inflation, it's rolling over, it's been at 2% for the last, you know, 3 or 6 months. Growth is fine to good, you know, so I mean, but not so hot that it's causing a problem. Wage inflation is modest, and if anything, you'd prefer for it to be a little bit higher than it has been. Like, there's no urgency to do anything more significant. And so what that means is if you're trading the currency, you know, the challenge is the currency is going to trade based on the U.S. dynamics much more. You know, the dollar yen is going to trade much more on the U.S. dynamics than on the Japanese dynamics. And so, you know, that's,
I mean, we have you know, if I took an EKG of US dollar yen right now, it would look like the patient was in a coma. Right?
Yeah,
what's that mean? Just a quiet nature? I mean, they say never sell a sleeping market. I mean, this market's asleep. Except for intermittent spikes, you know.
And part of that's because we sort of know that the MOF, you know, if things start to move, you know, through the 150 mark, which, to be clear, I think, you know, they certainly could move through the 150 mark. I don't think it's like particularly, I don't think they're like particularly enamored with 150 as a number that they must defend. But we all know that the MOF is going to, you know, fuck with the speculators, which is in their nature. And if you've been in this business long enough, you've probably been fucked with a few times by the MOF.
Fluctuated again.
Right.
It's just a fluctuation. Anyway, so, all right. So, you know, I'm trying to think of where we can go from here. When you look at what's happening geopolitically, though, Bob, are you know, it's hard to be hopeful for me that something that is biblical, that it's the same as it ever was. You could go to the Old Testament, and this is a rerun. The only thing that's changed are the weapons. What do you think is going to be the future? Do you think the U.S. is going to stand by Israel no matter what, or will they be on their own as the pictures from Gaza start coming in after they do invade, which, you know, I think they're going to do it regardless of what our president wants them not to.
Yeah, I mean, I think I don't know is the reality, and if anything, I'm a taker, an absorber of information around these topics rather than really having much of a perspective view. I wish I had an edge in a perspective view, because it would be great, probably, given how it's going to influence markets in the near term. I think in general, like I think about it more like from a value perspective, in the sense of like thinking about what is priced into markets, right? What is priced into markets, and I go back to particularly the gold market. What is priced into the gold market is secularly low conflict. And while I have no particular view that it's going to pick up, it's going to be China, Taiwan, or, Russia, Ukraine and beyond, or, Israel against Iran's proxies, like I have no particular view of which of those is likely to escalate further. But the idea that that we're going to have a global environment that looks a lot like what it did, in the post, the post-Soviet era for a few decades, it seems unlikely we're going to have the level of stability that we had, starting back in the late 80s that we had, for a couple of decades. That seems like a low likelihood. And so, being all in on peace doesn't seem like it's the right trade. Or the right positioning yourself well, given the distributions.
Okay, so a big event happened here in the market, and I know you're not a big technician, but I wanted to ask you about it. It's the S&P 4200 level, which everyone eyed before we went through it. On the upside here was 42, and that's where we became pretty parabolic. Then we pulled back to it and held. People got long against it, and now they took out the stops. Some of the leaders have been under a lot of pressure, like NVIDIA being a darling, pretty ugly week, head and shoulders there. I mean, Amazon under a lot of pressure. Apple really still is down 20%, 15%. I'm kind of thinking what led the market up is going to be what leads the market down. A lot of people still love the Magnificent Seven. Don't you think that at least a few of the Magnificent Seven have been sent to Boot Hill to be buried?
Well, you look at these companies and you look at what's expected in terms of the earnings, right? Which is something like 25% earnings growth on the S&P 500 level over the next 2 years. And you say to yourself, okay, like let's go bottoms up. There's a lot of companies, there's like 490 companies where, earnings growth does not look particularly good in this environment. And certainly on a forward-looking basis. And so we're really relying on a handful of companies to deliver that earnings growth. And I mean, Tesla's a good example. Like it doesn't take much disappointment to create a real gap in terms of what is going to transpire in the market. And so, and this is like, you've been down this path a whole bunch of times in terms of, cycles and how the cycles play out and things like that. And there's something very familiar with what we're seeing right now, which is that there's always this point in this market cycle where it's like kind of everyone has kind of given up on recession. It's not going to happen, and earnings are going to be good. And and X, Y, and Z is different. Like whatever X, Y, and Z is, housing market, pets.com, whatever. It's always X, Y, and Z something is different. And then what happens is like the reality just kind of comes in, and it's like it just is not as good as what people are expecting, and then you start to get that sort of rollover and the downward dynamic, and you can see it in these technical charts, like breaking. Through.
I mean, I'm looking at the banks, Bob. So I think there was a warning on our terrible earnings Friday on one of the regionals, and even though the bonds have stopped going down, like they're coming off Niagara Falls, they're grinding down.
Yeah.
These banks are in worse shape now because yields are higher than they were in March. Do we still have a banking crisis going on?
I think we have the banking problem is a little subtle right now because those banks are not creating good earnings, right? Those are bad equity investments, but they're not necessarily systemically a problem, right? Take a Regions Financial, still running a 3.5 NIM with 60 basis points of NPLs. Like from the perspective of a bank, from like a systemic perspective, from the likelihood that that bank failing is very low, very, very low. Now, the likelihood that that bank kind of sucks as an equity holder is reasonably high. But what the Fed cares about is not if holding Regions Financial, stock is a good return. They don't care about that. What they care about is whether the bank is going to fail. And they've done a pretty good job putting themselves in a position to ensure that the banks aren't going to fail. But for equity holders, it's not going to be a pleasant ride here.
Yeah, and it's not just the regionals. It's the money centers.
Some of the money centers, and we're actually seeing that. I put something out this weekend, which shows that actually the financial pressure that you're starting to see is actually in the largest banks. The largest 25 banks are actually seeing the biggest financial pressure, where they saw less pressure after SVB, whereas the small banks are actually doing okay.
Why is that? The flow of deposits has gone towards the big money center banks. Why has that become created more pressure on their financials?
Well, I think a lot of those money center banks, are still holding. And when I say money center banks, I mean you have Bank of America, which is still holding too much duration, and then the regionals are really in that space. It's really the super regionals that are feeling that pressure, whereas frankly the stickiness of smaller banks, like your XYZ credit union or the small bank in your hometown, like those banks, they have very sticky deposits, like people bank with them on a relationship basis, and it's not that bad. And those banks are actually seeing some resetting of their yields that they're getting on their incremental loans. And so if you're running, a bank with 50, 100, $250 million of assets, it's actually like it's not a terrible time.
Okay. What's wrong with Goldman?
I don't know. I mean,
they're supposedly best of breed, right?
They're always the smartest. I don't know.
I like when Goldman goes down because they didn't hire me and I had to go work for JT. and I had to go work for JT Marlin.
Well, you're doing all right for yourself now.
You remember JT Marlin?
Was
in that movie, Boiler Room.
Boiler Room, baby.
Yeah. So, I went in there and we had a nice little markup on some fraudulent paper. Anyway, Bob, it's so great talking to you. I want people to be able to find you. So I put up your website here and you have your own ETF. How's the ETF holding up, say the last month or so? Is it market perform, a little under, a little over?
Yeah, I mean, what we're seeing, I mean, the thing that we've seen with hedge funds and what we're focused on is seeking to replicate what the gross of fees returns of the hedge fund industry and how they're positioned. And what we've seen is basically hedge funds have been super conservative all year in terms of their positioning. And now that conservatism is actually paying dividends, whereas we're seeing pretty bad market action in stocks and bonds. Hedge funds are running their lowest risk that they've run in a long time. And so, holding up while the rest of the market has been going down over the course of the last little while. And that's pretty normal. That's basically how hedge funds navigate recession environments, is that they play safe, they play conservative when asset prices are doing poorly. And then they, come back in when asset prices are doing well. So that's how they can achieve what they're doing. And if you look through recessions through time, hedge funds outperform in recessionary environments. And so I think we're positioned to do the same here.
Your day in the sun is coming.
That's right. I mean, look, as long as it's not YOLO NASDAQ, as the only answer, right? It'll be okay.
Yeah. Well, you know, everyone watching, you know, Bob's views and perspectives are sought everywhere. He's been on every financial station that you could name because he's able to clarify complicated things for laymen like us to understand it. So here's Bob's website, and he has a blog that you could check out to see what he's viewing, and you could follow Bob at Bob E Unlimited. Right?
Yeah, check me out on Twitter. That's where you get sort of the sort of day-to-day takes in terms of how I'm thinking about it. We actually like talk through a bunch of the stuff that I've been posting and talking about the last couple weeks as well. So definitely check it out, and you know, ask questions, comment, whatever. It's great to interact with people out there.
You're doing a great job as a watchman for us, Bob, by keeping us informed with what's happening that you know, we couldn't see unless you provided your perspective. So appreciate the great work that you and your team does, and thank you for coming here early in the morning and having a little conversation with me.
Yeah, I love it. It's always great to talk to you, Dale, and such a wealth of perspective. And I love, you know, because I come from a fundamental sort of macro perspective. I love getting into the technical perspective. It's, you know, it's a totally different lens, and one that I really, you know, you're obviously have incredible expertise at, and it's always great to have these conversations. So thank you for having me on.
I'll put a trade on based on my technicals, and then I'll go around and check your stuff out to see if I have any fundamentals backing up what I just did. Anyway, Bob,
I put on trades and hope to God the technicals are aligned with what I'm trying to do.
Yeah, we're the opposite. Anyway, whatever works for us, Bob. A million ways to skin a cat. So
that is very true.
Bob Elliott, my trading warrior brother. Check him out. Follow him for sure. Thanks, Bob. I'll catch you in the winter.
Awesome. Definitely.
All
right.
Talk
to you later.
Good hunting, Bob. All right, everyone. That's a wrap for F.A.C.E today. You could join the team in about 15 minutes on the Morning Edge, and we'll see you for Turnaround Tuesday. Don't just count your pips, count your blessings. I'll see you guys.